About property, coming back to the outlook for the overall economy, I'm not particularly confident about this, but I think we're just going to bump along for a while yet. Essentially between 2 and 3%. We need a couple of years of stronger growth than that if we're going to get unemployment seriously down. Now, turning to the long term, I've gone back to the consensus forecasters and said, don't tell me about this year or next, tell me about the next 10. Who's going to grow and who's not? And they have said you can put Australia at the top of the list. Our growth prospects for the next 10 years are rated higher than any other country here. So this remains not a bad place to live, work and invest. Incidentally, I participate in the survey that generates these numbers. The firm in London, England sends me a form every 6 months that looks like this, except there are no numbers on it. I've got to fill in my forecast and send it back. And then they basically, it's a pretty good business model. They get 450 people around the world to send them our forecast. They take the average of the forecasts and sell the average back to us. If I don't forecast an economy, I'll leave it blank. And down the bottom, there's a space for comments, and I always write exactly the same thing. And here's what I write: I don't care where Australia finishes, as long as we beat New Zealand. And you can see we've done that. But while I've been prattling, you've been saying, yeah, but where are the interesting growth stories? Where's China? Where's Asia? Here they are. Different story now. I put Australia back in. Different perspective, but there's no disgrace to be outgrown by Asia. We should be grateful for the strong growth in Asia. These are our export markets. And they're playing catch-up still. Up the top, I'd call this a dead heat for first between China and India. Does reinforce the message. 10's not coming back. If India's going to grow as fast, well, 10 years from now, a decade from now, in trend terms, if you like, India will be growing faster than China, guaranteed. Biggest single reason, their demographics are so much stronger. So, is it possible there's an Indian boom out there for us to take advantage of as big as the Chinese boom? No. First reason, the Indian economy is only half the size of the China, so even if it grows at the same rate, that's only half the growth. Secondly, they'll never be as resource-oriented. But the India story will get bigger, but when I think about this, I'm reminded, a bit oddly, I will admit, of the episode when Kerry Packer bought Channel 9 from Alan Bond in the late 80s. Many of you will remember that. He bought it from, Kerry Packer sold Channel 9 to Alan Bond. And then a couple of years later, he bought it back from him at a fraction of the price that he sold it to him for. And at the time, he said famously, you only get one Alan Bond in your life. And you have to take advantage of that. And it's the same with China. We only get one China in our life. Now, the year they have a hard landing, and they will one year, we will feel that. And there's nothing we can do about that. It'll still been a good story. So in summary here, big question in the US is when will rates begin to rise and how quickly? This will be a big question tomorrow morning, which is why, incidentally, we scheduled this for today. The Eurozone battling deflation, didn't talk much about that, but growth actually looking better in Europe, and those markets have been doing quite well. That doesn't mean they're going to continue. We'll always worry about China. That's just a reflection of how good a story it's been. We're going to limp along for a while yet. As I said, residential construction doing okay, consumer spending doing okay, export growth doing okay. The one guest that hasn't shown up at the growth party is non-mining capital spending. Why not? I think one of the reasons for that is low confidence. Why is confidence so low? You make up your minds, but when I think of low confidence being as low as it is, I've got a C word in my head, and that word's Canberra. The cash rate likely to fall again. The exchange rate may fall further, and the Australian share market is actually probably right now is probably a bit above fair value. These are the important messages I've tried to deliver. I always leave my most important message for the very end, and that's this one. So I'll stop there, and I hope there's time for questions. Thank you.
Chris, thank you very much indeed. Questions before Chris flies off. He won't be able to stay. Sadly.
Chris?
Yeah. Yes.
Taking into account the overall measurement of the Australian share market, in late, 2007, peaked at 6828 points.
Yep.
Do you think we, in this current cycle, will get to that level?
Yes. But it's taken. I actually took a slide out of this presentation which benchmarked the fall and rise of the Australian share market against the previous, what I call big ugly bears, episode where the market's fallen by 50% or thereabouts, which is what it did on this occasion. And on previous occasions, it's never taken longer than 6.5 years to get back to that previous peak. So there's no question this is the longest, slowest recovery. And I suppose when I say yes, I mean, it's not going to be, smooth sailing all the way. It's taken us, it may still be, well, I got 5,800 at the end of this year, so it's still looking like, I would say, at least another 18 months to 2 years beyond that. So if it peaked in November 2007, and it gets back in this, it's going to be almost 10 years. Almost 10 years. Obviously it'll get to 68.28 one day. But what I'm saying is it will get there without, shall we say, a 15 or 20% fall between now and then, because you could count that as a new peak lower than the previous one and then down again. But yeah, looking at it that way, it'll be close to 10 years. And I said it's never been longer than 6.5 before. Yeah. Yes.
I was over in Perth last week there, it's looking at sacking 4,000 miners.
Yep.
That's in the mining industry. That's a lot to be laid off in one hit.
Yes. Let me come back to this. We're getting there. We'll go here first of all. Yeah, mining. You're right. Mining's not a big employer, so 4,000 people is quite a lot. The mining did quite a job. Between this starts in February 2011, so here's mining employment growing, and then it went nowhere for a couple of years, and then this is what has happened. And it's not a big employer, but what happened last year, in the year I think to November last year, is shown here. I skipped this slide earlier, so. Essentially last year the mining industry was the biggest source of jobs loss in Australia, 44,000. And your example says, yeah, it is still happening. It is still happening, mining. While we've got the slide here, here are the losers. There were more winners last year. I'm not quite sure who gets into professional, scientific and technical services, but here's your residential construction boom. Yeah, there's no question mining employment, certainly last year and probably still going on this year, biggest single source of loss of employment. And of course, that could be one reason why the Queensland line is not looking too flash, since mining employment is very important in this state.
That Fortescue is in big trouble.
Yeah, I saw a headline there. I haven't looked any more closely than that. Yeah. Yes.
I have a question about mining as well. Despite what Mr. Abbott says about coal, the talk coming out of China is that its demand for coal will fall markedly in coming years. So that's going to impact on the Queensland mining industry even further, isn't it?
That is. I suppose, possible. Obviously, China's use of coal will peak one day. The only question is that 10 years from now, 5 years from now, or maybe just a couple of years from now. And obviously, yes, that does have important implications, particularly since we increased our capacity to pull the stuff out of the ground in the expectation that not only that the demand would keep growing, but the prices would keep going up. That will be a challenge for Australia, and more so, it'll be a challenge for the two resource-rich states. Yes. Yes.
How do you think the free trade agreements that are coming on are going to help Australia in a big way?
The answer to that is, economists disagree about a lot of things, but as a general rule, we believe that the freer trade is between economies. Let's just put it this way: the benefits eventually always exceed the costs. And so economists generally in favour of freeing up trade. Now, of course, you've got to free trade agreement is not like there's many different kinds, and you've got to be clever in negotiating it. But as a general rule, in a well-constructed free trade agreement, the benefits to both sides turn out to be roughly equal. as a general rule. We will be opening up the Chinese markets for a lot of soft commodities that wouldn't otherwise happen. Australian consumers will benefit to some extent from even lower prices, although it's hard to see how they go much lower. But go back to what I just said. As a general rule, the gains on both sides tend to be about the same. And now consider the fact that's in total. Now consider the fact there's like 1.4 billion of them, and there's 23 million of us. On a per capita basis, we should be looking to negotiate free trade agreements with all the big ones. But as I said, you've got to do it. You've got to, it's not just, you can't go in and say to somebody, let's have free trade, and they say, yeah, okay. There's all kinds of codicils and subparagraphs, etc., that all have to be negotiated. But and it doesn't make very much difference to the economy in the first day or month or year, but eventually it should.
Do you feel that China and India starting their own coal mines, do you think that could be a danger for Australia, like in time where they monopolise the price of coal?
China's had coal mines for a long time. Obviously, and I think we've learnt in this episode that we're a price. We knew all along we were a price taker, and so anything that affects global supply does have ramifications for Australia. But the one thing that we have to our favour in the case of coal is that and I'm no expert in this area, but my understanding is the quality of Australian coal is far better than the global average, and that will always be to our advantage. But if the interesting thing is, of course, when the price falls, China's going to be more reluctant than it otherwise would be to use its own supply, because it's going to be uneconomical at that price. If the price were to double, then they'd be looking to open up coal mines all over the place. So it's the price. It's all interrelated with the price story. But we've known all along. We just fooled ourselves, if you like, into that when 10 years of rising commodity prices. We fooled ourselves into thinking it was always going to be that way, and it was never going to be that way.
Chris, one at the back.
Forecast a major correction next year, or
a major correction of the market. No, but suppose another question. Suppose I go to sleep tonight and wake up on my next anniversary, and somebody tells me there's been a major share market correction. You have to tell me what caused that. And I would say, well, the Greek exit from the euro must have been messier than I thought it was. But I don't. Markets around the world are not massively overvalued. Economic growth around the world should probably do better over the next couple of years than it has in the past 2 or 3. So I don't see the next couple of years as stellar years for share markets. But I would, if let's do the question the other way. If you told me that over the next year markets were going to move by 15%, I'd say far more likely up than down. I'm sorry?
With that in mind, and last question, you've got like the FTSE been stuck where it is again now, been trying to break through that level for years. It's back up to 68, 80, whatever. And it can't get through it. Every time it's been up, it's been knocked back down again. So if that can't get through that, surely there must be a correction coming.
Well,
whatever they do, it affects us.
I'm sorry, who are we?
The FTSE, Britain.
In Britain, yeah.
Our market must be affected by them because they're so much bigger than us. Like whatever the Yanks do affects us. They are.
But we follow the US far more closely than we follow the FTSE. The FTSE also follows the US to some extent. But no, I wouldn't. Let's put it this way: you're the first person who suggested to me we should be looking at at technical levels in the FTSE to figure out what's going to happen next to the Australian market.
Only about 2 or 3 to 1 now. We're out of kilter with them. So we've got to link ourselves to. We're much more likely to be in some sort of parity to the FTSE in the last 12 months than what we have in the S&P.
Yeah, but
the S&P can't get through that sort of level. It's been trying to get through the years.
No. You said the S&P then. Do you remember the FTSE can't get through the level?
Yeah, the S&P was 2100 back up there now, but the FTSE was 68, 80.
Yeah.
Some sort of magic
No,
number.
no. As I said, you're the first person, and you may be right, but I haven't formed a view on this question because I've never been asked it before. Right? You're the first person that suggested to me that technical levels on the FTSE are an important determinant of what's happening in Australia. So as I said, I haven't thought about it. Anybody else? Well, if there are no more questions, I've taken longer than I intended to, so I've held up the lifestyle speakers. I wish I could stay because it wouldn't take anything. It wouldn't take too much to get me on a cruise. I'll tell you.
Debbie, did you give him a
Thank you for your
card?
time.
Chris, thank you very much indeed. Really appreciate it. Okay, if you want to stand up and stretch your legs for a moment or two while I get the next set of slides up, and it'll also do you good because